Welcome back to the fastest growing life insurance podcast on YouTube. My name's Caleb Williams. I'm here with Don Rufran, and I just realized that I butchered the whole intro. So we're going to be reacting to anti-infinite banking videos on the internet. I already introduced everybody. Just know that Dom and I, we've specialized in designing properly structured life insurance and have helped placed over $2.5 billion in death benefit. And we're going to be seeing what these videos have to say and if they're really telling the truth or are they lying about infinite banking and whole life insurance. So without further ado, let's dive in. And I'll also say this is the Caleb losing his voice edition of the And Asset show. So no, I didn't hit puberty, and I'm not going through that for those. So if you're thinking about commenting that, just save your calories, and you don't have to type that. So Don, you ready to react to videos? I know this is your favorite thing.
My favorite thing of all time.
Whole life insurance is the biggest ripoff in America, and here's why. Number one, it costs 20 times as much as term insurance. So for every $100 you pay per month, you can get the same amount of term insurance for $5 a month. Number two, studies show the investment returns average 1% per year versus 10% with the S&P 500 index. Number three, the cash value you were building up, when you die, the insurance company keeps it, not your family. Number four, the IRS calls the returns tax-free simply because it's, quote, a return of a deliberate overcharge. In other words, they charge you too much, and then they give you some of that back, and they call it a tax-free dividend. They claim it gives a higher return than it really does, and it's tax-free because they're just giving you back your own money. Like one insurance salesman secretly told me, whole life insurance is for selling, not buying. It's the most profitable product they sell because they're ripping people off who buy it. The insurance companies line the skies with expensive buildings and pay lobbyists and contribute to the campaigns of politicians to prevent them from writing laws against them. I don't care what they call it. Whole life, universal life, infinite banking, stay away like the plague. Buy term insurance and invest the difference in an S&P 500 index fund over a 40-year working lifetime. A $500 a month investment into your IRA in an S&P 500 index fund at 10% annual return will give you $33 million, which your family keeps when you die. That same amount in a whole life policy at 1% annual return will give you $3.5 million of cash value, which the insurance company keeps when you die. Seek financial advice from a licensed financial advisor and not an insurance salesman.
My first take on this is we got to add music to our videos. Like I do appreciate a good flowing video with music. I'll just share a couple thoughts, and then you can give your take on this. He makes a claim that term insurance is 20 times cheaper, and sure. And that's not always true, depending on what age group, how you're structuring. A lot of times when you do max funded insurance, because he's using the word infinite banking, you'll use what's called the term rider. And so some cases it could be true, could be not. So that was a claim that he shared very strongly. And why does that matter? It's just as like, okay, you potentially are cherry picking that talking point, but sure, we'll take it at first value. He says, studies show, Dom. I love how people say that. I need to say this more often. Is like, yeah, studies show. It's like, okay, what studies? Studies show that that life insurance earns 1% a year. Okay, I would love to see the studies, and I also would love to see, like, again, who are we talking about? Or is it one of those like, yeah, I could cherry pick whole life insurance policies that are typically designed with a stock company, but even the ones that are like not max funded at all. Even the ones that are not max funded at all, even the ones that are like very middle of the road, long term are going to earn more than 1%. So I don't know if they're factoring in. I don't know what's being factored in, but studies show it, so we can't debate it. This talking point number 3 is insurance companies keep your cash value. I honestly think I should have a button on my desk that I just click like our response to that, because it's like everyone is like, what do we go to Dave Ramsey University to like talk about life insurance here? Like I don't know what to say at this point. Yes. Like you get the net, you get the death benefit. In a lot of cases, the death benefit increases. Anyone that's max funding policy, even if it's not properly designed, and when I say properly designed, I'm not saying like for maximum cash accumulation. Your death benefit is going to grow far more than what you've put in. So the talking point is emotional, but it's not even a very good talking point. So that's what I'll say there. And then he talks about dividends. He says dividends, and he like, you know, talks about like your cash value. He doesn't actually say dividends. He says your cash value is, you know, grows tax free, but it's like then he mentions like dividends or return of premium. And he's getting them mixed up. Like in the revenue section 7702 in the revenue code, like it says, if your policy passes 7702 rules, the IRS treats a life insurance policy and gives it tax advantages, which is tax deferral. So that's that. In addition, the dividends that get paid in whole life are considered return of premium, and so those dividends in addition are being able to be tax free, whether you take them in cash or that you quote unquote add them to the policy. And so yeah, there's tax code that gives these benefits, and then the dividend portion is quote unquote a return of premium, and everyone makes the assumption like, oh, this is definition of what, it's a ripoff. It's not true. And there's cases that people get way more they get more dividends than what they've paid in, and then the whole argument kind of, you know, teeters, because it's like, oh, wouldn't that logically not make sense if your dividends are greater than what you've put in? So it's a point that I'll make, because it's another talking point that it's like they'll like cherry pick because it's a return of premium. It's just them saying you're getting ripped off, but these are the same lobbyists that are saying it's almost like, hey, this is a scam, and oh, by the way, these people have lobbyists, so we have to like come after them because of the laws that they're making. And it's like, what do you think some of those laws are? Oh, maybe the thing that you literally put as one of your examples, as like this is bad. And then the last thing I'll just say, when I first watched this video, he went to like the $500 a month, and in my head I just kind of autopilot, like I know what the numbers are going to be, and he pulls out $33 million. And I'm like, what in the world? So I actually, being the nerd I am, I put that into like an investment calculator, assuming, Dom, a conservative 10% every single year, no down years. We won't factor in taxes because why? You don't have to pay taxes. That's assuming 63.4 years, earning 10% every single year. We're not factoring in taxes. That's that assumption. And so I love how you just casually, like, you just put $500 in a month, earning 10%, you'll have $33 million. It's like, okay, great. I'm like, that's awesome. So all that to say, I'm sure he's a super great guy. I'm a fan of the music choices, by the way. And I also think that, you know, I would be really interested in having these people on. I hopefully that people know this by now. If anyone wants to come on, especially if you have like a channel, if you make content and you're saying life insurance is a ripoff and all these things, let's have a discussion, because what you'll find is we're not here trying to say all life insurance is good. In fact, we probably have more content that's going 2.0, 3.0 than the original talking points that talk about these aspects. So Dom, I know I went off on that, but just love to hear your takes and on that video.
Yeah, thanks, Caleb. And I thought you had really good points. I think I'm at a stage of exhaustion to some degree or another, where I just hear the Dave Ramsey universities, cult-like, conversations. There's just a world today where there's so much abundance of education out there that I think that the lack of understanding and sophistication of how some of these products work, I think there's no exception or reasoning for people not to really know how these work in today's day and age. Now, to his defense, his video was like 3 years old. So I know that there's videos that we have maybe put out that I'm not the most proud of once upon a time today. But I still know that there's plenty of people today that just say it with definitiveness because they heard a Dave Ramsey video without actually truly doing the research themselves or trying to understand, why was this product created? How are the use cases around it? And how does it actually work? And me, credibility is important, and I have a hard time validating a credible source. You know how I feel about YouTube channels that have 183,000 subscribers, but these videos get 300 views. And so, for better or for worse, that's just sometimes it's hard for me to to look from a credible perspective, like he's speaking things that are really making change and impact from a financial perspective. The actual numbers.
Shots fired, dude. You're just going right at the YouTube jugular. I feel like you hopefully didn't ever jinx us, because I feel like that could age poorly. So I'm gonna keep working hard to make sure that
exactly. If that happens to us, then that means our content starts to suck. we start to suck. I mean, it just is what it is. So can't hide behind the numbers sometimes. But speaking of hiding behind the numbers, could you said it was 63 years?
63.4 years.
63.4 years to be exact. In the video, he actually gives us a time range. He actually says 40 years. And so I did the math, and in 40 years is actually like 3.3 million-ish, I think is what it comes out to be. And so I have a hard time validating credibility too when the numbers are that far off. And even when he says in a 1% whole life policy, let's just pretend that is true and that's the case. He says that's a 3.3-ish million, and a 1% whole life at that number would only be like 295,000. And so with that being said, I don't have much else to say excluding what you already said, and just I mean, this is
I feel like that's probably instead of insulting his YouTube, which I don't think we should be in the business of doing. I think you should insult that plain that's the talking point number one, is let's look at the math, because the guy that's yelling at you about misinformation is literally like, all right, let's get the numbers right. Like, your talking points are better by saying that life insurance doesn't even break $1 million. So that's at 1%. So that's very interesting.
And the last thing that I'll say is that whoever his insurance agent is that says that whole life is for selling needs to get out of the business. Just, if you're actively saying that behind closed doors, that is very unethical and very integral in a lot of ways. It's one thing to think you're doing the right thing and you're trying to do the right thing and you just happen to be doing the wrong thing. But another thing to say, I'm openly doing the wrong thing because I know it's the wrong thing. And that's just wrong at the end of the day. So that's the last thing I'll say.
Yeah, I just want everyone to appreciate, I am bringing this up now, but I did that whole mention and didn't mention that life insurance is not an investment. So you should thank me later. But I will say it now because it's very important that would be the core thing that I would lean into. And I think he would be like, okay, it's not an investment. I think if anyone is selling it like an investment, I'm going to agree with you. I think what ends up happening is you take a lot of oxygen away from the pitch or the comeback, because if you're selling insurance, especially 1% whole life insurance as an investment, I got news for you. Like you not have a great situation, and so I think it is important. And so I'm sorry for bringing it up now, but I couldn't help myself because I feel like we wouldn't do it justice if I didn't mention that. All right, let's get to the second video. This guy, by the way, has got a phenomenal channel, and we're only going to react to a portion of what he says. But I mean, I'm a fan of Tom Talks Money, so I'll say that as we get rolling.
If you spend any time on TikTok or Instagram, you have seen the videos. A guy in a fitted suit tells you that the wealthy don't use banks. He says they use a secret tax loophole to become their own bank. He is talking about infinite banking, or bank on yourself. This is a strategy that uses overfunded whole life insurance policies to create a pool of cash that you can borrow against. The pitch is that you borrow from yourself, pay yourself back with interest, and capture all the money that would have gone to a traditional bank. It sounds incredible. Why pay Visa 12% when you can pay yourself? The problem is, once again, the math. When you borrow against your policy, you are not actually borrowing your own money. Your money stays in the policy as collateral. You are taking a loan from the insurance company and they are charging you interest. You have to pay that interest. The proponents of this system claim that because your cash value continues to grow while you have a loan outstanding, you are engaging in arbitrage. If the policy pays you 4% and the loan costs you 5%, the net cost is small. But wait, why would you pay a net cost to access your own money? If you had that money in a high-yield savings account or a brokerage account, you could just withdraw it. Cost zero. With the insurance scheme, you are paying a spread to access liquidity that you provided in the first place. Furthermore, if you don't pay that loan back, the interest compounds against you. It can eat away at your death benefit and eventually cause the policy to lapse. If the policy lapses with a loan outstanding, you get hit with a massive tax bill on all the gains you thought were tax-free. It is a high-wire act that requires perfect execution. The other issue with these banking concepts is complexity. I have reviewed policies for people who tried this. They have spreadsheets that look like NASA flight plans just to track their premium payments, loan repayments, and dividend reinvestments. Life is messy. You lose a job. You get divorced. You forget to check the mail. If you mess up the funding of these policies, they can implode. Compare that to the buy term and invest strategy. You have an automated transfer to an index fund. That's it. You don't need a consultant or a spreadsheet to manage it. In personal finance, simplicity is an asset. Complexity is a liability. Complexity hides fees. Complexity creates points of failure. The be your own bank strategy is the ultimate example of manufacturing complexity to sell a product that most people simply do not need. So who actually wins in the infinite banking scenario? The insurance agent. These policies require massive premiums, often tens of thousands of dollars a year, to work properly. Remember that commission structure we talked about earlier? A $20,000 annual premium generates a massive payday for the person selling it. This is why you see so many influencers pushing it. It isn't because they discovered a secret of the Rothschilds. It's because the compensation structure for selling permanent life insurance is one of the most lucrative in the entire financial services industry. If you are ever confused about why a financial product is being pushed so hard, follow the money. In this case, the money leads directly from your bank account to the agent's commission check.
Most people have no idea where to start or how to really evaluate whole life insurance. That's why we've built The Vault. It's all of our best life insurance resources and educational tools all in one place, all for free. We have calculators, handbooks, crash course, deep dive videos on numbers. If you want to learn more, click the link in the description or tag comment below to unlock The Vault. All right, back to the video. Dom, before I give my 2 cents on this video, what would your reaction be to this?
I'll be like, good job, man. Like, thought it was done really well. And I would say that if I was looking at it from an objective view, nothing in there really screamed like manipulation, lying, trying to say something that it really isn't. And that's what I like appreciate about this video more than other videos, because I think that sometimes the other videos don't necessarily like share like the full context. Like when you say, hey, like whole life gets 1%, it's like, well, it can, but also that's not fully the story. And I think that in here, what he did is he just talked a lot about some of the cons of whole life insurance, and that the things that he said also can happen in a lot of ways. And so I actually would say I support this video, and I could give color commentary to and so or and if while it was happening in a lot more color that would make more sense. But I don't necessarily have anything bad to say from a reactional perspective in this guy's video per se.
Yeah, no, I would say I like the video. I mean, he says a lot of what he talks about infinite banking, what people say, I think we would agree that they shouldn't be saying that. Like wealthy don't use banks. Like, excuse me, like show me a really wealthy person that doesn't use banks. There will probably be some examples, but that's not like, I don't think that's a great message, and yet it's an emotional message that really, makes people want that, because they're like, yeah, I don't want to work with banks. And then when they talk about arbitrage, I feel like we're one of the only channels that have really harped on this. We have lots of videos, lots of public interviews and discussions around like life insurance doesn't give you arbitrage. This is a conversation that we're going to lean more into, because a lot of people say, gotcha. Like, oh, you just admitted it, Caleb. And it's like, no, like I do believe it gives value arbitrage, because you have to value other things in life insurance. But the cash on cash borrowing using your policy, which most people that push infinite banking, that's the only thing that they talk about. They're being misleading with math. I don't think most people are actually trying to scam. I don't think that across the board. I just think they really don't understand how it works, and they're just being misleading. So I agree with them there. You know, and it's like, yeah, it would be really dumb to pay like, oh, I'm going to put my money in here, and let's hypothetically say I'm going to earn 4%, and oh, it's going to cost me 5% over here. It's like, congratulations, you just got a negative 1% bank account. Like if that's all we're talking about, yeah, I would agree with what that person says. And then probably the biggest thing that I think he mentions that I think is a very, very good point is complexity. Even if like we really try to make things simple, people that work with us, we have a whole servicing team. We really try to simplify, have amazing service. Most people have like, you got to like try to get a hold of your agent, and it's a terrible experience. In addition, the way that they sold life insurance was like very complicated. And if I'm being honest, Dom, like I look at a lot of people that have been sold a bill of goods using life insurance. The life insurance policy could even be structured properly, but it's so dang confusing. And that's one of the reasons why we don't sell life insurance in this complex system. Like we really try to sell it like as a, like, yeah, it should be integrated, but you should understand what you have, and it shouldn't be represented of being like, you're going to sell this because of these 10 other steps that you do. And even on the best case scenario, it's more complex than having your money in a savings account, investing the difference, and buying term. And so that is why not everyone should do it. It's going to be unpopular for some of the people watching this, but it's like, that is why we shouldn't try to like convince everyone and their mother-in-law to do permanent life insurance, all these things, because even if what you're saying, Mr. Agent or Mrs. Agent, is correct, you have to think about, is that person actually going to capitalize on the thing that's in your brain? That's something that I've learned just in my journey, is there's different paths, and just because I think a certain way doesn't mean everyone thinks that way. And to have humility to say, actually, number one, this strategy might not even be right for you, or number two, insurance, this is how you need to incorporate it as a better bond. And all you should be doing is putting your money, investing it, and life insurance could be a better bond and some other supplements, but it might represent a very smaller portion of your portfolio if that's the thesis. So that's what I'd say. And I mean, I think it's good to give exposure of like who's incentivized to selling you this and how do they get paid. And so all these things I think are important. I think it's important for people to hear from us to say like, listen, two things can be true. This video is super well done. The point that we saw, there wasn't anything crazy, but it's one-sided. Just like a lot of people are one-sided. We're one-sided in a lot of cases, but we just really try to do our best to hear different perspectives. And you might not agree with us, but I think you would at least have to respect the fact that we're willing to have conversations like this. Whether you think we're right or wrong, we're trying to increase the conversation and not trying to just yell at you about these talking points and hope that you don't see the other side.
I think you said that last part extremely well. Rarely, if ever, trying to dunk on another thing like buy term and invest the difference, or necessarily dunk on IUL or VUL, specifically like a different product, Roth IRAs, like try not to dunking on the other products and strategies as long as they're not unethical in a lot of ways that could essentially blow up, is kind of the way that we try to operate as a company. And I do believe that too often or not, people are in such the one camp or another that they get emotionally attached to a product or to a strategy, and they get lost in really what matters the most is like, does this help the person that it's intended for? And I think that's really what matters at the end of the day, versus like driving a massive ego stick to say like, this is bad, this is a scam, and what I know is a lot better than yours at the end of the day. So trying to just be a lot more mature in the communication and the language that we speak as we grow older, because some of the most wise people that I know, you know, if you look at like the Bobby Samuelsons of the world, et cetera, like the way they speak about life insurance is just so sophisticated and profound. And like rarely would you ever see them speak about, you know, this other product over here is like the worst product in the world, or, you know, you just start talking, downgrading all other things, because they just understand money in a different view and lens on the life. So, yeah.
Awesome. All right. Last video. It looks like we're going down Dave Ramsey lane here.
Dwayne is there. Dwayne, how can we help?
Yes, sir. I have a $200,000 term,
for 20 years. It's got about 19 years left. I'm coming up off another one. That's why I got this other one, so overlap it. But because I'm just coming up off the first one, I'm wondering maybe I should get a whole life. And I'm listening to what you and I think Suze Armand, everyone say, hey, whole life is bad. But every time I talk to the mutual mess and these other, they're convincing me, no, it's a solid, you won't lose money. And so I wanted to call directly and find out, what am I losing when I start talking to them that it seems like I'm pretty firm on while I'm listening to what you guys are saying? Is there something I'm missing in translation?
Well, Dwayne, here's a simple way to think about it. What would they stand to gain by persuading you to get whole life versus term life from them?
I'm sure it's some kind of financial gain.
There we go. The commissions on whole life are astronomical, and there's a good reason. Your term life policy costs about 5% of the cost of an equivalent whole life policy. And so when you're paying, 15, 20, 30 bucks a month for that term policy versus 600, well, there's a lot more wiggle room for them to steal your commissions under the guise of, well, you're going to build this cash value policy and you're going to invest it over a long period of time. You're going to make so much money, Dwayne. Don't invest in the market. Invest with me in this insurance policy. Do you see what they're doing there?
Yeah, but it does sound like, again, this is when I'm talking to them, I get overwhelmed, the numbers and everything. And when they get done, they say, hey, look, see, you put this money in, which to me is a huge amount of money per month.
It is. That you could be investing yourself into much more solid investments that have a much better track record. But what they do, well, I'm guessing here's what they did. They did some real fancy math that was real complicated to where they're like, well, Dwayne, you just got to trust me, man. This will work.
Yeah. Yeah, I have a little. I'm going to just throw this. Let's get out of the money. You started the call by saying that you agreed with us on whole life. You've listened to this and you have an opinion on this yourself. True or false?
Yes. When I listened, I said, hey, that sounds right, because it felt crazy, the money they're asking for.
Right. So hold on. So
who
stop.
can afford that?
I know. So stop. So remember why you feel that way. We've made a case and we didn't convince you. You convinced you. And so you walk away going, that's nuts. It's crazy to put all that money in there. It just doesn't make any sense. You got to remember that. Do you trust yourself? Do you trust your common sense? Do you trust that opinion that you came to before you ever walked in and talked with these guys?
Typically, obviously I do.
Well,
but
I know. So no. But what happens is if you sit down and somebody makes a really compelling case and they've got this thing down pat, then what they're saying makes sense too. But then you go, it doesn't make sense. But now they're making it sound like it makes sense. You just got to say, I don't think it makes sense. I know it doesn't make sense. Here's why. I think it's crazy. And then move on.
Well, there's a fear factor too, that after 20 years, what's going to be the cost of another term? I'm 50.
Dwayne, here's how
George
term
can
works.
tell you that.
So the idea is that you don't have insurance for your whole life. The idea is that you follow the Ramsey plan. You pay off your house in 15 years if you do our plan with a 15-year fixed rate mortgage. And 20 years later, you've got a huge pile of money in your investment accounts. And then you become what we call self-insured, where you don't need that money anymore because you have more than that in your investment account. And you only need it if someone relies on your income like a spouse.
And George, real quick,
simple.
just break that down. The money that you would invest at whole life and the return on that versus the money you would put in the 401k, the stock program, mutual fund program based on the growth of the whole that 9 yards that we the return on that is big time different. Break it down quickly.
Yeah. So if you take the difference from that whole life premium with your term premium, take the difference that you would have paid and you pop that onto our investment calculator at RamseySolutions.com. And let's say you get an average return, even 8 to 10% over 30 years. See what that would turn into by doing it on your own. You don't need them because all they're doing is taking most of that in commissions for the first bunch of years. And eventually maybe you'll get a crappy return. So avoid this at all costs. And why even talking to these people? Go talk to our friends at Xander. They're not going to sell you this whole life crap, and stop even entertaining these fools.
Yeah, it's absolutely right. Good advice.
You got me riled up.
Well, I love when you
I lead a sad life that's what gets me riled up, Ken, but it's fine.
Well,
I am actually going to take an angle that I don't think I initially thought of when I watched this for the first time, but it hit me when I rewatched this, is Dwayne called and he has $200,000 death benefit. I think the first conversation needs to be like, Dwayne, help me understand why you came up with that number. Like 200,000 feels very, very underinsured. And like, I just have so many questions, but I would say, yeah, go with your gut all day long. And even if you're working with someone like us and it just doesn't feel right, don't do it, period. Don't let anyone talk you into anything, because in my experience, if you get that feeling, your gut will never lie to you. And I'm not convinced that. I think Dwayne should buy a much bigger term policy and not do permanent insurance at this point. And that's what I would say with the facts that I've seen, because he could not articulate anything other than like what they're selling. And so until there's like a strategy and like integration and to say like, hey, this is what I'm doing, if you're looking at one sole product, I can't tell you how many times they said the word invest, hence why we say all this time life insurance is not an investment. So if someone's even selling you insurance, whether it's whole life or IUL as an investment, blah, 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 fear factor, like you mentioned earlier, Dom, not a fan of that. And normally it makes you feel like, man, I really got the short end of the stick. That's what I would say about that. And then the last thing I'll just say is we could have a real conversation about self-insurance, like be self-insured, all these things. And I think that we could have a like big time question. Maybe we should do a whole episode on that around, okay, so there's inefficiencies of self-insurance as well, of like, oh, you have this nest egg, now you can just live off of it. And there's a world where it's like, okay, let's talk about the pros and cons. The pro is you don't have to pay any insurance. Yay. The con is if you value certain things like legacy and other things, there's a world where some of your assets, yes, you have money, but you're maybe not able to use it as efficiently. But I'm telling you right now, Dwayne's not ready to have that conversation. I think we need to talk about what your human life value is first and foremost, which is another way of saying how much life insurance should you get. That should be the first conversation around life insurance. And then the second conversation should be how much money do you have? What are your outcomes? What are your goals? And going back to there's like a simple, medium, complex. I think most people should just opt to do simplicity. And so those are my thoughts there. I actually very much like, I don't have any major disagreements, and I'm definitely not gonna try to defend the life insurance angle here from what I heard on this call.
Yeah, there was one part in the video that I was just like, that was really good, like really good. And that was the part where I think it hit you the second time you watched it as well. When he asked the question, he was like, we didn't convince you. You convinced you. Like, do you trust you?
Yeah.
And that sentiment, that statement was like, amen, brother. Like, if you don't feel good about it and you don't understand it, you don't like, that's how you get buyer's remorse. That's how people essentially speak bad about the way that it actually functions, because they end up getting into this self-doubt that what they have is true. And that's where the product gets a bad name for itself at the end of the day, and it's not going to be good for you and your family. And so I couldn't agree more with Caleb in regards to the plan. Is like, get term insurance, get more of it, buy term, invest the difference, follow the Ramsey plan, whatever that plan is. And I thought it was super interesting, as I was thinking about it, as you were speaking around the idea of self-insurance too. I never thought about it in this way, so you just said it. But I do low-key think self-insurance is kind of low-key selfish when you think about it to some degree or another, because you're saying, I'm going to create this nest egg, and then I'm forcing myself to spend this nest egg down. And then there is no world where I'm going to probably have anything left over for anybody when I die and pass away. Let's say I make it to 85, 90, whatever, or a very, very, very little amount. And I just thought that was interesting because, like you said, if you do care about legacy and maximizing that for the next generation, nonprofit churches, helping, etc., the idea of self-insurance really becomes selfish if that's what you care about. And so the one thing that I'll say that came up across the board in all of these conversations is that the commissions on whole life insurance are astronomical and extremely high. And I just think that this conversation is very fascinating, like the more you break it down. And the reason why I say it is, one, if you're buying something that doesn't add value to you and you're paying a ton of money for it, like 100%, like it's way over expensive, right? But it always does come down truly to like the cost versus value, like the value that it brings to you versus the cost of what it is. No, I saw a clip with Hermosi and he's like, yeah, like my Hummer's out there, it costs $200,000. And he's like, if I asked you guys to come up with 10 grand on the streets, even if you had no money, would you be able to come up with it? And he's like, yeah, of course. Like you would get it from somebody, you would finance, you do whatever you possibly can, you get a credit card, because you realize that the value for it was worth $10,000. Like that value is so much more than just $10,000. And so if you're wanting to save your life and you're going to need to get surgery, you'd be willing to pay $100,000 to the surgeon to making sure that you live and survive because you understand the value of what you're paying. And so if you're willing to pay for something because you understand the value of it, then the dollar amount that the person on the other end makes from it should not really be relevant, in my personal opinion, because of what you're getting on the other end of it. Now, there's a whole other side to the unethical side of whole life insurance and the commissions,
Totally.
et cetera. I've been doing the math as of late, and someone that does sell the typical traditional life insurance that's made for death benefit estate planning, they will get $100,000 for $100,000 premium versus somebody that maximizes the cash value will only get close to maybe $17,000. So you only get 17% relative to the 100%. And the commissions are so much lower when you design it a specific way. And this is why I actually think that the industry the turnover is so high, because I think in our space, the typical traditional insurance planning model is dying, because I don't think that a lot of people know how to do that type of planning, and it's becoming more and more known that people don't want to pursue that. So that's like one thing. But another thing is then if they try to pursue like the model that we're doing, where you feel like you're doing the right thing, which is providing more cash value, liquidity, you don't make a ton of money and you need a more volume play, and it's a lot harder to stick around and do, and you eventually just fade out because you don't make enough. And then nobody ever talks about the model of like the 1%, 2% fee that is on the other end of it. If you like really talked about long-term over 30 years of like what one would make and give up in a 401k fees wise to like what one would pay and give up into a whole life policy, it's a drastic difference just looking at it from the short term today perspective. And, so we could pull a math on that conversation real easily.
I think that was well articulated. And even if we're not obsessed over here about, oh, you paid this, so of course it must be bad. But like, if you want to play that game and you're promoting mutual funds in 2026, and that's what you're promoting, and we just look at the fee structure in over 30 years, I'm not saying this is what I'm not saying. I'm not saying whole life versus investing. I think we've been really clear that it's not an either or. But if you just want to play the game of who got more of your money over 30, 40 years, you may be shocked by this, but it won't even be close. It will not even be close. The investments that you would pay with a 1%, maybe more, mutual funds have all kinds of loads. Like, though, I just one of those. It doesn't necessarily make them bad, but it's like if that's the talking point, and you charge a 1% management fee, like just be careful, because again, that's not inherently bad. Like there's nothing wrong with that. I'm just saying, like that over time, you're like that. That's not going to age well if that's your message around someone getting paid. And it'll be so. All that to say, you're spot on, and it's something that we probably should like. It would be interesting to do like a calculator around this. Around like I don't love the concept, but it wouldn't be that hard to be like based on some assumptions. It's like over 30 years, you'd be paying your insurance person X and your investments X kind of deal, and it'd just be an interesting way to get people to think differently.
Yeah, no, for sure. That would be awesome. And the last thing that I'll say is I actually respect other people's opinions wholeheartedly. And I love that people have a different opinion. They have strong beliefs and they have conviction. And so I don't know either of these guys' names, but the guy on the left, like, it's very apparent, like he's done his homework. He's looked at calculators. He's drinking the Dave Ramsey Kool-Aid. You know, he's essentially a mini Dave Ramsey. Like even the way he gets so passionate around whole life and speaks around it, like it's just very apparent, like it's his son or something like that. Right. On the flip side, I don't know much. This is just a short clip. So maybe the other guy on the other side, he would prove me wrong in different clips, but it's very apparent the guy on the right was just sharing by default and not necessarily saying by conviction, because he's done his own journey and his own research. And so I just really would love for people that are communicating some of this stuff to like have a definitive conviction around why they say what they say versus just saying because it seems like what everybody else around them is saying. So that's the last thing I'll say.
He's like, show him you did the math. Tell him. Like, just like for what it's worth, Ken Coleman is the person that you're feeling spicy today. I think he's one of the greatest interviewers of all time. I love his ability to interview. And then obviously George Camel is awesome. Like he does really good videos. And yeah, I think he's going to be the next Dave Ramsey. I think that's kind of where the direction's going. All right, let's get to Q&A. By the way, if you enjoyed the show and you realize that I'm putting my voice on the line for this show. Just if you haven't subscribed and hit that bell and you haven't commented, like, just know, like, we're putting effort into this. So you may not appreciate it. You might wish that I took the day off, but the show's got to go on. So appreciate you all. All right, Dom, do you want to take the first question?
Amazing. Okay. Infinite banking just seems like a way to bring complexity and risk into your life unnecessarily. Just get out of debt and invest your money in assets that gain value. I love that. That's a great comment, a great statement. I mean, I seriously, like, getting out of debt and investing your money in assets that gain value is an incredible advice, like truly incredible. In creating simplicity and not creating complexity, that's how you create real peace in your life, right? And so, like, I'm the person that just wants to say, like, amen, great advice. If he's saying on the other side, like, whole life insurance is a terrible product for other benefits that come with it, like, we could have a different conversation, but I don't disagree with what he's saying. I could assume and read between the lines, but at the end of the day, like, I love it.
Yeah. I think if you shouldn't do something that feels too complex. So if you feel like it, great. And if in having conversations with whether it's our team or somebody else, if it's just way too complex, you can't get your head around it, you shouldn't do it. So yeah, that's what I would say. We could have another discussion about the risk and life unnecessary. Like, we could have that conversation, but we don't need to go down that path. The next question is, IRR below 6% is not worth pursuing compared to the S&P 500. Will pay over 10% IRR or growth. ETFs, S8CHG will IRR over 11% over 40 years. The compounding difference is huge. Forget infinite banking route. I would just say one's an investment and one's not. And if that's the route you want to go, great. But there's a world where life insurance and investing could actually give you a greater outcome. I noticed in this comment you didn't say anything about, like, distribution, income strategies. So it's like it just
taxes.
There's lots of different aspects to this. And so, if you're just looking, if you wanted me to bet over the next 40 years, what net worth is going to be greater if you just put your money in insurance versus investments, I would put my money on the S&P over the next 40 years. I'll bet on America. But that doesn't, if you just give me those two options, that's what I would choose. But that's not me endorsing, put all your money in X, Y, and Z. It's like there's integration that potentially is lacking here. And I also think that there's a world where incorporating them both together could actually give you a greater outcome. Whether net worth shows it or not, it's greater from a planning foundational income strategy. So that's what I would say about that. Dom, anything you want to mention?
No, I just think too often, either the comments or the videos we're reacting to, they're very definitive statements in a box. And there's a lot of truth and validity to what people say. Like you can't argue, like, the statement around some of the things that they're saying in regards to, like, numbers, percentages is what you get. But when you peel back the layers, the onions of, like, what we're trying to communicate and how we can help people, there's just a lot more to it with the benefits and how whole life insurance and permanent insurance can be used in someone's portfolio to get a better result. And that's what I love that you just said, is, like, you said, a result. The result is what matters the most, not necessarily, like, quote unquote net worth. I'd be a whole lot happier to have a result that creates peace in my life than something that gives me more but creates chaos in my life, right? And so I'd rather have less that creates the result that I want than more that creates massive destruction.
Yep. Last comment. Love this one. What do you think about MPI Unlimited? I have very strong opinions on MPI Unlimited. I've actually interviewed Curtis Ray, the creator of MPI. He's sent me a legal letter, and I read it publicly on YouTube, so you could check that video out. I'm not shy to his face. I'm not shy in other videos. I do not think MPI is going to age well. I personally would not touch it with a 10-foot pole. And I think it's going to create many black eyes. It's going to create a black eye in the space. And it's a lot of people are going to get hurt because of it. So it's using a life insurance, index universal life, it's my understanding that Mutual of Omaha is one of the companies that they use, and they're selling you a bill of goods with IUL, the pitch, but then they're using internal leverage as well to ramp everything up. And in a perfect world, it's going to work out amazing. And in an imperfect world, it's going to be far from amazing. So that would be my opinion on it. And check out videos. If you just type in Curtis Ray or MPI Better Wealth, you'll see some videos, and you might even appreciate the video that I said Curtis Ray just threatened to sue me, and my response. That might be a good place to start.
Yeah, I think if you're willing to take on the risk and not knowing the end result, and you want to chase the rate of return for what could be, it's a strategy worth pursuing. But I don't think that the risk is worth it. The risk worth the juice worth the squeeze. That's what the saying is. Like, I just don't think it is at the end of the day. If you're willing to bet your entire quote unquote retirement or financial portfolio on an unproven strategy, with a lot of other great strategies out there, buy term, invest a difference, right? Investing in your business, investing in real estate. Like, there's a lot of other things that can create the result that you want versus gambling or betting or hoping that something that is unproven will work down the road. And so it's the bet you're willing to take. Like, if you want to take it. And if you're not, then don't. Like, it's simple as that.
All right, guys, we appreciate you. If there's something we can do to help you with your policy review, or if you want to talk to someone that will help you with your outcomes and figure out, is insurance integrated into your financial strategy going to benefit you, we'd love to work with you. And as always, thank you so much for subscribing, hitting the notification bell, and we love your comments. As you can see, we not only love your comments, but we will react and review to many of them. And so thank you from the bottom of my heart. And Dom, I know you feel the same. So we'll see you next week.
If you're an advisor, life insurance agent, or someone who just loves the life insurance space, we have a must-attend event for you. It's our 5th annual Life Insurance Summit, June 15th through the 17th, right here in Nashville, Tennessee. Not only are we going to have the biggest names in the life insurance space, but this is also an incredible opportunity for you to meet and connect with like-minded individuals and be a part of our ever-growing community. Learn more and get your tickets before they sell out in the link in the description or pinned comment. Can't wait to see you there.